Good morning, everybody, and thank you for joining us for our market update. We know that the transition to online events has also meant that you're inundated with invitations, so we really appreciate that you're taking the time out to spend it with us this morning. It would be remiss of me not to acknowledge that our performance over the past year and a half has not been what we wanted. We take this incredibly seriously, but we also know that it's in thinking calmly, researching thoroughly, and acting judiciously that we will make the right decisions for the future. And that's what we've been busy with. Every position has been reviewed again and again, and we've used opportunities that the market volatility over the past few months have given us to reposition parts of our portfolio and also to affirm our conviction in the positions we've chosen to retain. Since the markets bottomed in March, we've seen a very strong recovery, locally and globally. But this recovery has not been broad-based. In fact, our market has become even narrower. There are quite a lot of shares that are still trading at very depressed and multi-year low ratings. It's very important to understand that some of these shares are the ones that are most likely to provide investors with excellent returns going forward. And part of the reason is that the local market has not only become skewed in its narrowness in investment returns, but also in its belief that there can be no good outcome investing in South Africa. While we do not dismiss the very serious situation we found ourselves in as a country, we believe that in parts of the market, the pendulum has swung too far. It is therefore very important that we identify these mispriced opportunities and position our portfolios to take advantage of this. We believe at present there are very compelling opportunities, both locally and abroad. Our speakers today are Greg Hopkins, our CIO, Dirk Jooste, one of our fund managers, and Kevin Cousins, our head of research. Before I hand over, please a reminder to fill in the questionnaire at the end. We have applied for CPD points. If you have any issues during the webinar, please comment on the app or send us an email. The contact details are there. And we're also going to answer some questions towards the end. If we don't get to your question, which you can post during the presentation, or if we haven't answered it throughout our presentation, as we always try to do, somebody will get back to you after the presentation. On that note, I'd like to hand over to our speakers, and I hope that you find our presentation today of value to you and your clients.
Thanks very much, Annette. Morning. Hi, my name's Greg Hopkins. Welcome. As you know, through the course of these presentations, those that of you have attended them in the past, we really like to try and answer your questions, the things that are top of mind for you. And there seems to be two broad questions that we keep getting through our distribution channel. And the first is, why do you own SA Inc. shares? And then there's usually a pause given. And at the moment, it seems that the market has got a very strong focus on the fact that we are in a potential debt trap at the moment. And we're incapable of fixing our issues in terms of just focusing on, I guess, on government execution. The second is linked to that is, given the structural issues that our country is facing, it seems apparent that there are better growth prospects elsewhere or just about anywhere else. And implicit in that is that South Africa will lag the rest of the world in terms of coming out of the COVID crisis. The second question that we'll be tackling is, where are the best opportunities for the local investor? So the focus on today's presentation will be looking at local opportunities in the JSE. The tone of these questions is very much local is not so lacquer. And those that know PSG asset management, in terms of what we have been saying in the past, we don't typically agree with that. We do think there's some very good opportunities locally, and we're going to be sharing them with you in a couple of minutes. But because these are two big questions, we're going to enlist the help of three of our larger holdings in terms of trying to help you understand in terms of how we're positioned. But before we jump into answering those questions, I'd like to just pause and explore the role of insurance in a portfolio, and more specifically how we approach, how individuals approach the task of buying insurance. Now, this story goes back to the dark days of lockdown, and I was listening to a very interesting podcast titled Decision Making in a Crisis. You can see why it caught my attention. And the guest on this particular podcast is a person by the name of Annie Duke. She's a former world poker champion and is now a consultant to business leaders in the financial services industry. And she gave a very simple example around the role of insurance and how we purchase it. She said, if I build a brand new house and the weather's beautiful, there's no clouds around and the sun is shining, buying fire insurance is not going to be necessarily top of mind, even though at that stage it's going to be very inexpensive. But when the fires are raging at the doorstep and I go and buy fire insurance, at that stage it's going to be prohibitively expensive. And there's actually some simple concepts behind this. The first is that we generally focus on the visible risks that we're seeing in front of us. And when we see those visible risks, we like to try and insure against those risks. We like to try and buy insurance to protect ourselves against those risks. And we typically get the odds wrong because these risks are so visible. We tend to outweigh them, maybe too much. And secondly, when we rush to buy insurance, given we sometimes get the odds wrong, and by that stage, the insurance is often very expensive, and we overpay for insurance. And typical insurance policies that people are buying at the moment in their portfolios is cash, local cash. We've seen a large move from risky assets into local cash. Offshore tech is another good example. People think that there's better growth prospects there, and they're also trying to hedge against the rand. And gold is another one which has made its way into the portfolios of many South Africans at the moment. And gold seems to be the elixir, that will solve a lot of the current market concerns. And if we look at the South African market now and we see what the market is typically focusing on, these are the risks that the market is trying to insure against. It's poor government execution, low visible growth, and rand weakness. And what's interesting for us is that these are the risks that the market is not trying to insure against, that there is some chance that the government might execute on some of their policies, that the SA economy might just actually recover, or the rand might be a little bit stronger than the consensual view is, and most people think that the rand is going to be weak. And what's interesting to us as well is that when we look at the market positioning on the left-hand side here, we think there's a very strong consensual view, and the way the market is positioned in a cluster of a small number of stocks, that they're trying to protect themselves against this risk. And put another way, the way the market is currently priced, we think the market is giving almost a zero chance that the government will execute on their policies in the future. And when we take a step back, we don't know what the odds are of government execution. We don't know whether they will or they won't in terms of over what time frame. But we don't think that the odds are zero, and we're going to talk about that in a couple of minutes. And what's interesting here is there's a group of shares in South Africa, which people call the SA Inc. shares, which would actually provide very cheap insurance against this, this happening in the portfolio. And now I'm going to get a little bit technical, so just bear with me for a second. But there's also a subset of those SA Inc. shares that have some defensive characteristics or some hidden rand hedge benefits. And because they're so cheap, you're actually getting some cheap insurance to cover you against these risks as well, the risks on the left-hand side. So you almost could think about them as a multi-risk insurance policy. And we're going to be sharing two examples with you in a couple of minutes. But let's just first focus on the macro risks facing South Africa. We have massive challenges. And it seems at the moment that we're right in the epicenter of this crisis. And the South African economy and our government finances were quite fragile going into COVID, and COVID has just accelerated some of the trends in terms of the deterioration of the fiscal position. And what it has meant is that it's actually elevated the role of government execution to a very high level in people's minds. Now, in this emotive time, it's really, really important to have an evidence-based framework. And in an upcoming webinar, we will actually unpack the framework that we use and the checklist that we use to try and help us actually navigate this very difficult environment. But what I would like to do is focus on some of the things that we think that get less attention in the media or when we talk to market participants. The first is that interest rates at the moment are at 55-year lows. I mean, that's amazing. It's the lowest interest rate since 1965. And this is something that I think sometimes the market misses, is that this is very different from previous crises in South Africa. In the past, at this point in a crisis, our central bank would typically be raising rates because they would be protecting the rand and future inflation. But inflation is well contained at the moment. And these low rates, we think, could set the foundation for future growth in the economy. The yield curve is now very, very steep. And a lot of that is because there's fears about supply coming on in the long end of the yield curve. But generally, when you see a steep yield curve, it generally precedes economic growth. Now, we don't know what the precise odds are of growth improving in the future in South Africa, but we certainly don't believe it's zero. The second is we're seeing commodity prices improving, and the rand has been relatively weak, which means that our terms of trade have improved dramatically. Our current account, our trade surplus year to date, and I saw the numbers this week, is close to 100 billion rand. That's a big reversal on last year, and it could also provide the foundations for potentially rand strength in the future. Now, once again, we don't know what the odds are with any precision on what the rand will do in the future, but the chances of it strengthening is certainly not zero. The third is around our corporate restructuring, corporate actions, and our companies have taken this opportunity, this COVID, crisis, as an opportunity to actually right-size their businesses and do a lot of the stuff that they probably wouldn't have been able to do otherwise, in terms of actually restructuring some of their divisions and some of their assets. And what's, in terms of our opinion, and we've seen this happen in the past, the market generally always misses this at inflection growth points in terms of the operating leverage embedded in companies as they've, go through a restructuring phase. And this is something in terms of earnings growth in the future. We don't know with any precision, once again, what the chances of significant earnings growth in the future, but the possibilities, the probabilities certainly aren't zero. And then the next point, and this is probably one of the most important, is that the private sector, we think, has got a big role to play and could play a big role in the recovery of our economy. And the Business for South Africa plan, this recent one that they've rolled out, is probably one of the most pragmatic and comprehensive plans that we've seen from business in a very long time. And just to give you an example, and the part of this plan has been about acknowledging the structural issues that we have in our economy and acknowledging some of the different ideologies in our ruling party. An example would be that there's a recognition that the state needs funding for this bold infrastructure plan, and the private sector can play a role. And they've been preemptive on this, with certain conditions. And if this plan is adopted in any form, it will go some way in terms of mitigating or reducing the risk of future prescribed assets being implemented in this country. And we've talked a lot about this in the past in terms of that we think parts of our private sector are absolutely world class. And we'll talk about this in a couple of minutes in terms of two examples. And it's been frustrating for us that, and Sean LaRue alluded to this in the recent winter update. It's like having Lionel Messi on the sidelines and not being able to get a game. But there is a chance that Lionel Messi will get a game in South Africa in the coming weeks and months. What was interesting for us is the Business for South Africa, a COVID crisis plan, in terms of government response. Large parts of that plan was actually adopted by the Treasury, and we think that this follow-up, growth plan, could potentially be similar. And growth is the missing piece of the puzzle here. When people are focusing on debt to GDP, and this is the big focal area about the debt trap, if you see growth improving, it both improves your debt picture because you get rising tax revenues, which reduces debt, but then also the denominator, when you have rising growth, and the combination of those two, could see a reversal of the current trend that we're seeing in debt to GDP. Now, once again, we don't know what the odds are, but they're certainly not zero. We seem to be past peak COVID infection at the moment. And this has tended to see a bottoming of asset prices and improving confidence in terms of post-peak. Now, this is not a central forecast, and we've chosen to take a more conservative approach in terms of how we've modeled the impact or the potential impact that COVID could have on our portfolios and our portfolio companies. But there is a chance that the second wave of infections that we're seeing in the developed markets won't occur in South Africa, given our open economy. And if that happens, there's a chance that the markets might start pricing that COVID is done. And that also might open up possibilities for our government to accelerate potentially lifting border controls and improve and encouraging tourism. Now, once again, it's not a central forecast, but the odds of this happening is certainly not zero. And the last is, and we go back to the first quarter. Capital outflows from emerging markets in the first quarter were the highest that we've seen on record. Some people talk about it as being a 5 sigma event. There's a very material impact on emerging markets and on South Africa. And there's a chance that the herd could return back to emerging markets. And if it does, South Africa will get some of that benefit given our deep and liquid markets. And the weakness in the dollar and the recent strength in emerging market currencies could be a harbinger of some of this money returning back into emerging markets. And if it does, it generally lifts local asset prices and improves currency, and you could see a stronger rand. Once again, we don't know what the odds are with any precision, but we don't think that they're zero. So I'm going to spend a minute in terms of just giving you a sense in terms of why we think this is a fertile ground to be constructing a 3M portfolio. Those long-term investors will know about our 3M philosophy. What we're trying to do is just find some inherent quality in a business that the market might be missing. So this is very much a quality assessment. We're looking at the business model, the moat, and the track record of the management team. And what really gets us excited is when we can find above average quality, so companies with superior economics and superior management teams with superior track records at below average prices, i.e. with a large margin of safety. And it's typically in periods of uncertainty and fear where you do find these opportunities, and particularly when there is some sort of temporary problem that is a fixable problem, that when that problem clears, the inherent quality of that business starts coming through. And COVID, we think, has provided that opportunity for finding these mispriced quality operations. And if we look at just some of the characteristics of our portfolios, I'll just share in terms of why we think this is a classic 3M PSG portfolio that we have at the moment. This is a snapshot of the return on equity of the largest 15 holdings in our portfolio. Now, return on equity is a proxy for quality, return on capital. And you'll see that the return on capital or quality proxy of this business, of our holdings, is almost 50% higher than the market. And companies with higher returns on equity generally compound at faster rates over long periods of time. And it's very evident if you look at the previous shareholder return for these businesses in terms of total return. It's been significantly higher than the market, almost a 3-to-1 factor on a cumulative basis. And if we look at the management teams that we in the investee companies that we own, they're very large holders, them and insiders or strategic shareholders in those businesses. Almost 2 trillion rands worth of ownership, almost 5.5 billion rand at a median level per company. That's very, very significant. And these managers and these owners and these insiders think and act like owners, and they generally take a longer-term approach when making their investment decisions. And they're using this opportunity they're seeing in front of them to actually right-size, restructure, and actually buy and take market share in their businesses. But what's very interesting for us then, when you look at this above-average quality, is that trading at a big discount to the average company, at a price to book of 1.1 versus 2.6 in the market. And we think when there's temporary issues that clouding this inherent quality lift, we think we could see a rise in these share prices and a closing of that valuation gap. And also what's interesting when you look at our portfolios from a bird's eye view, what you'll see is a few things, and this is just showing the geographic split of the profits of the underlying investee companies. What you'll see is that there's a nice diversification across our portfolios. We don't like to have all our eggs in one basket. But what you'll see is that even though a large number of our SA Inc. companies do have businesses in South Africa, do have businesses and exposures to South Africa, also have significant offshore businesses, which the market isn't currently pricing. They're pricing all of these revenues or these profits as SA Inc. So you're getting a portfolio of assets incredibly cheaply priced, but actually less dependent on SA GDP growth. And this is one of the beautiful things about that hidden portfolio insurance, and I'll talk about this in an upcoming example now in terms of ACI. But these are some of the examples of the companies that we own in our portfolios. These are some of the larger holdings in those various buckets. So here's a good example of one of the companies in the top 15 holdings, above average quality, below average price. This has been a longer term holding for us, ACI. And if you look at ACI from a geographic sort of basis of geographic split, and this shows the underlying domicility of their customer base. 60% of their revenues go into South African customers. Now, a lot of people will see this slide and they'll read the headlines in South Africa and they'll actually move on to another company where they think there'll be better growth prospects. But what's interesting is often the best opportunities are those that are less visible, where you're going to have to look at them slightly differently to find that opportunity. And if you actually look at the look-through revenues in terms of where ACI's customers sell their product, you'll see that this business has got a very large, the majority of the earnings, almost 2/3 of their revenue, have these rand hedge characteristics. But it's priced as an SA Inc. company. Almost 50% of ACI's revenues go into the mining industry, which we're seeing the tailwinds are starting to get in behind. And it's interesting, if you look at South Africa, you look at ACI, and you look at the macro backdrop in terms of the influence that it's had on this business. This slide just shows the South African Chamber of Commerce and Industry Business Confidence Index. There's a couple of points. You can see that business confidence at the moment is at 20-year lows. And you can see that over the last 10 years, you can see this slow decline in confidence, the lost Zuma decade, a lot of people are calling it. But what's interesting, if you overlay ACI's earnings on top of that, you'll see that over the last 10 years, ACI has actually done incredibly well. It's grown its earnings at just under 10% a year, and its dividends actually grown at a faster rate, at 12% a year of that period. And this is one of the dangers about taking these macro views and then making calls on how they might influence the underlying companies in South Africa. And ACI has done incredibly well despite having a very tough economic backdrop. And when we look into ACI, we see some of those world-class businesses that I talked about earlier. 30% of their profits come from their mining chemicals division. This business has 90% market share in the local market, mining chemicals. And it's got the largest mining chemical treatment facility in the world. So really world-class. Another 10% of their profits come from their water and solutions business. This division processes almost 80% of South Africa's water. I mean, this is truly an essential service. And a further 10% comes from their asphalt production business, Much Asphalt, which has a 60% market share across South Africa. This is very much a local champion. And when you look at the last two businesses, these are infrastructure businesses. 20% of their earnings come from these businesses. And they'll be very big beneficiaries if the government can execute even partially on this big infrastructure drive that they're embarking on. These are going to be very much very significant tailwinds for this business in the future. And if you take a step back and you look at 50% of the revenues in mining and another 20% in infrastructure, you have 70% of this business which could have significant tailwinds in the future. So when you're thinking about growth prospects and you're thinking about growth prospects abroad, there are companies in South Africa which could do pretty well. In fact, we think ACI's best years are ahead of them in the coming years. If you look at it from an earnings power perspective and the impact that COVID has had on this business, we just start with the adjusted earnings per share, which is an indication of previous earnings power. And this is at the end of December for the 12 months preceding. And if you look at the first quarter, it was interesting. ACI was actually grew its earnings at 22% year on year in the first quarter. This is a business that was moving onto the front foot despite a very difficult economic backdrop. And then COVID hit, and you can see the impact that it has on the business. It's been relatively significant. And what's interesting for us is that they've actually captured, from day one of COVID, of the lockdown, they've captured every revenue and every cost of that COVID has had on their business. And they did it for a very simple reason, that in their insurance policy, they've got a pandemic insurance clause, which is quite different from a lot of other companies and makes them quite unique. And it gives them some confidence in terms of their ability to actually claw back these COVID costs and lost revenues. Now, we're not basing this into our assessment of how COVID will of their earnings power in the future. It's just a nice optionality on the side if they are successful. But you can see that it has had an impact in the first half of this business. But the good news is that as the economy is starting to open up, their business is coming back quite quickly. We think COVID will be a temporary issue. We're not sure how long it'll take them to recover their earnings, but we do think that they will recover these earnings in due course. And whichever way you look at it, and whichever way you think about the earnings power of this business, whether you do it on a pre or post-COVID basis, this company is either on a 7 times price earnings ratio or 9 times price earnings ratio. Now, we said that ACI, in our opinion, is above average quality company. It's compounded shareholder returns at 16% a year over the last 20 years, significantly higher than the average company. Now, the average company in South Africa trades at a 14 multiple over long periods of time. And here's a business that's trading either at half or a smaller fraction of that. So, in inverting that, there could be between 60 and 100% upside if the market starts recognizing the inherent quality in this business. And what's interesting for us, if you look at it, from a longer term trajectory perspective, this is the share price, this is the earnings, and we've taken an underlying earnings power basis. You see there's a big gap between the two at the moment. It's actually the biggest that we've seen over the last 20 years. What we're saying in effect is that the market is pricing that things are going to get materially worse in South Africa. Certainly not we're going to see any recovery. And if the economy does stay tough, as we've highlighted, these companies do make a plan, and we think that ACI will continue to grow their earnings in the future. I'm going to hand over to Dirk now, who will talk about another opportunity in our portfolios with similar characteristics, above average quality at below average prices, and some hidden qualities that the market isn't appreciating. Over to you, Dirk.
Thanks very much, Greg, and hi everyone. Okay, so I'm going to take you through our thinking around the JSE. We think the prospects are quite attractive, and quite excited about the tribute to bring to our client portfolios. So looking at the JSE and just explaining the basic business model, a good analogy to consider is that of a toll booth. Now, looking at what the JSE actually does, in South Africa, we have about 5.5 trillion of equity traffic that's generated annually. Very simply, the JSE collects about 99% of this traffic volumes that goes through their platform. In turn, they charge a 1.3 basis point toll fee. And for every R1 collected, this is a business that makes 40 cents of profits. So a very high return business. But very interestingly, it operates a cash-only toll booth, which means all the revenue that is collected translates into cash profits. This means that they are able to pay quite a generous amount of their profits out to shareholders. And what we've seen over the last 5 years or so, typically a payout of 70 to 100%. Just looking back since listing, how that translated into returns for shareholders, the JSE has provided 410% since its listing in 2006. That compares very favorably to the all share at 176%. So clearly we are seeing some good evidence of a very strong business model, a business model that translates to good shareholder returns over time. Just quickly contextualizing the quality that's on sale today, we will just compare the JSE to its global exchange peer group. We'll look at 3 simple metrics: return on equity, which is a quality metric, and then price earnings ratio and the dividend yield as an indication of value. So just looking at the return on equity, the JSE does have a very high return on equity of 21.5%, significantly superior to the market, and also significant above average looking at the global exchanges peer group, which is by itself also indicating as a peer group quite a superior return profile. But looking at the price earnings ratio, we see the JSE is currently available at half the valuation of the peer group and is providing for double the dividend yield compared to its global exchanges peer group. So again, we are seeing some good indications of quality on sale at below average prices. So clearly by now, one would be asking, why do we have this opportunity of a mispricing? And we do think the JSE is caught up in quite a few narratives that is providing this above average chance of a potential mispricing. Firstly, we know that we have very low confidence in South Africa. And again, coming back to the toll booth analogy, we believe that the JSE toll booth is just located in a very unpopular neighborhood at present. With low confidence, typically there's a lot of pressure on the financial services sector. And even though the JSE is a technology company, it is classified as a financial services company, and it does experience the weight should this sector be under pressure. Secondly, it's also classified as a mid-cap South African company. We feel this is a sector where there's an excessive risk premium embedded. And looking at the JSE, just on average liquidity, it actually trades at a reasonable level of 25 million Rand per day. And we're quite excited that we can include this in our portfolios and still make it a meaningful size, just considering our relative size to our peer group or competitors. So we're quite excited that this can still be a position that will have a meaningful impact to our portfolios. And then just lastly, we've also seen exchange competition being introduced, chasing the very powerful platform of the JSE. But what we've actually seen that the JSE's competitive position is proving to be much stronger than anticipated, with the competition only taking less than 1% of market share thus far. And also looking at global case studies, it's not always clear cut in terms of the impact that competition brings to an exchange market. Typically, the incumbent remains the strongest competitor, and we've seen varied success examples around the globe, from no success to some success, ranging between 10 to 20% of market share gains over a 5 to 10 year period. But by no means a foregone conclusion, and the market is potentially over-threating of this concern. Also, COVID-19 has actually delayed quite a bit of the competitive threats. We've seen a lot of the broker community just being very conscious of costs, and it's quite difficult to justify at this point of time having the capabilities of trading across both exchanges. Very quick case study, we look at the Brazilian stock exchange. This is quite relevant as being also another emerging market stock exchange. We just want to illustrate what happens if you potentially buy an above average quality business at low points in confidence and valuation. First, we consider the Brazil Industrial Confidence Index. Over time, the red shaded area just indicates a period where there was a sharp deterioration in confidence in Brazil. Looking at the Brazil Stock Exchange, a price and PE ratio. During that same period, it reached a low of 10 times earnings, with the share price basically going sideways for multiple years. Then in middle 2015, the president was impeached and there was an overhaul of government and there was a restoration of confidence. By no means a euphoric environment for confidence, but just a bit more of a balanced outlook. That translated into 300% gains from the Brazilian stock exchange share price. And most of this we can see is attributable to margin expansion, which is quite a good indication that the reality on the ground does not have to completely rectify before the market starts to reprice some of these high quality assets more appropriately. And quite interestingly, this is a stock that has hit an all-time high at an all-time multiple during the COVID period, which is just an indication of the market appreciating the defensive characteristics of these businesses. Now, just looking at South Africa, we clearly have a confidence index at all-time lows, and where we are with the JSE today, a low share price coupled with all-time low and PE ratio. So we think that's quite an attractive setup for long-term investors. Just maybe very quickly, we will look at some of the unappreciated attributes of the JSE. It's viewed as an SA Inc. play, but there are quite a few hidden defensive characteristics. So first of all, it's a business that actually enjoys turbulent markets, similar to the patrons here on the roller coaster that's full of smiles. We've actually seen the JSE grow its earnings 20% year on year during the first half of this year. Just a very good indication that this is a business that can grow its earnings quite counter-cyclical to the market, which is a very good attribute in inclusion in portfolios. Then embedded in the business model is equity market growth that grows typically, as we all know, as investment market participants, typically at inflation of 5 to 7. Just looking at the JSE business model, the revenue line is quite pulled in the same direction as the equity market growth. And if they can control their cost at inflation to 1 to 2, it's actually a very strong business model, what we refer to in the industry with embedded structural positive jaws. And also, even though it's an SA company, we know that a large component of the exchange is actually now representative of more of the global markets. 60 to 70% of the exchange profits are generated offshore. So we actually think a large part of the revenue drivers of the JSE is actually removed from the SA macro, but it does also present significant optionality if we see an improvement in the SA macro. And then lastly, the JSE showed significant resilience during the March and April period. We had hyper volatility and it was open without any interruptions or any failed trades, which showed just the resilience of the overall business model. So in summary, we believe this is a very good 3M opportunity. We think it's a business that's potentially under earning. We have a low starting multiple, low expectations and confidence, a high starting yield underpin, which we believe provides protection against further downside. And we've seen this as an above average quality business model. So in short, a very good recipe that typically results in superior long-term returns for investors, which we believe is a classic 3M PSG asset management opportunity. I'll now hand over to my colleague Kevin Cousins. He's our head of research, and he'll take us through one additional case study. Thanks very much.
Thanks, Dirk. Good morning, everyone. Out of favor areas are a rich hunting ground for our 3M stock opportunities. Emerging markets have disappointed on growth and their currencies have been weak. On top of that, as we rolled into 2020, the COVID lockdown hugely hurt businesses involved in the hospitality sector. And companies that screened as having leveraged balance sheets were sold off by investors. These three factors all apply to AB InBev, really raising the probability that there could be an interesting opportunity brewing, as it were. This chart shows the world's leading fast-moving consumer goods companies. The margins are on the axis, and then the size of the bubble is the cash flow from operations. ABI is a remarkable business. Its margins are some 40%, the widest EBITDA margin in the whole sector. And this is a crucial part of the economic moat, being a supply side factor. Now, what makes these margins sustainable? And it's their market structures. Most of AB InBev's large markets are single player or two player markets, and that enables like very, very wide margins and cash flow generation. The second thing that jumps out at you from this chart is scale. The size of these bubbles indicate the 2019 cash generated by operations. Now, scale from a moat perspective is all about relative size. So if we take AB InBev last year, they generated over $13 billion. This in contrast to closest competitors Heineken and Carlsberg, together generating just over $6 billion, less than half. So those two aspects of the economic moat, the market structure and the scale, are also combined with a third aspect to form the strongest kind of combination moat that you can find in a 3M stock. That aspect is on the demand side. It relates to their brands. AB InBev has more than 500 brands that they sell across 100 markets. And they range from local brands. So in South Africa, there would be our good old Castle Lager or Castle Light. And it's also right up to the leading brands globally. And they sell 7 of the top 10 brands in the world. Now, these brands bring one thing to ABI, and that is pricing power. A consumer automatically buys this brand of choice. It becomes habitual, and there's a strong allegiance. And they're prepared to pay more to drink their favorite brand. So if we look at our moat for AB InBev, we have supply side factors being market structure, we've got immense scale, and we've got strong brands. Analyzing management is extremely difficult to do objectively. AB InBev has a reputation for a very down-to-earth culture, flat structure, open plan. Carlos Brito, the CEO, never wears a tie. Young and aggressive. So it's a reputation that would talk to an ownership culture. But what are the facts that we can look to? The first is the incentive plans. They have vesting periods of 5 and 10 years. This is something Carlos Brito calls a cultural self-selection. If you don't believe in the long-term growth goals of the business, you're very unlikely to work there. Secondly, ownership. Senior executives own some 6 million ABI shares, which is about $340 million at the depressed price today. And then finally, long-term thinking. So what can help us evaluate this is management's decisions. And the most transparent area that we can see these decisions is in their balance sheet structure. ABI's balance sheet carries a lot of debt, as I mentioned earlier. In fact, at June, it was $113 billion of debt. Now, that debt could obviously trip you up if you can't service it, you can't roll or redeem it at maturity, or if you breach covenants. Now, when we look at how they manage this debt, it is a masterclass. If you were a financial director, the chart of the maturity ladders at the bottom is a thing of beauty. They term out the debt. The average term is 15 years. 95% of it is fixed. And they actively manage the near maturities by early redeeming and holding cash. In fact, their cash on hand at the end of June was $26 billion, more than enough to cover the next 5 years of maturities. Now, each of these decisions removes a massive tail risk to the business, but costs money. These decisions like this would not be made by a hired gun management team trying to boost near-term incentives. They're the kind of decisions an owner would make. So this gives us a great insight into how management thinks about the business. In 2019, 72% of AB InBev's volumes were sold in emerging markets and some 60% of revenue. Developed markets were 28% of volume and the balance 40% of revenue. Now, over the next couple of decades, those emerging markets are going to be vital for growth. But in the near term, what we've seen in the first half of the year, the geographic diversification to developed markets really paid off. In North America alone, AB InBev's on-premise sales collapsed, but the off-premise sales, in other words, take-home alcohol purchases by customers, grew some 25% 6 months on 6 months. And that enabled their cash flow in North America to be roughly flat, down 1.9%, providing a huge level of stability for the business. So we've discussed the quality of AB InBev's moat, a combination moat with market structure, scale, and brands. We've talked about how we believe management is very well aligned with us as owners and thinks long term. The last aspect before we get to a 3M stock is obviously what we pay, the margin of safety. And the confluence of negative sentiment that I talked about in my first slide pushed AB InBev's price down. At the end of March, we had a rare opportunity to buy it at less than twice sales or about 10 times normalized earnings. We believe this is one of the highest quality FMCG companies in the world, and it's going to compound and grow for many years into the future. As a top holding across our funds, we expect this to deliver excellent returns for clients for an extended period. Some good things did come out of 2020. I'd now like to hand over to Greg Hopkins, who will conclude.
Great, thank you very much, Kevin. And I hope those 3 case studies gave you some insights in terms of answering some of the questions that you had that we posed right up front. So in conclusion, we often forget that crises provide very, very good buying opportunities. What you can try to do when you're constructing your portfolios is looking for opportunity, which is the offensive part. We're getting on the offense, but also then the defensive part is looking for cheap insurance. There's a very strong consensual view in the country that we should be sitting in cash or in global assets anywhere other than SA Inc. And there could be a lot of pain if South Africa is a little less bad than we expect if our government just executes a little on their policies. And our portfolios, you can offer cheap insurance against that outcome in client portfolios, i.e., if things get a little less bad, we think our portfolios will do quite nicely. Thanks very much for coming. Thanks very much for attending this. And if you have any follow-up questions, please get hold of our distribution channel. Thank you very much. Bye.